Welcome to this substantive program of the Developing Partners section. In these substantive programs, we generally don't do introductions because we want to jump right into the program. But you are welcome at any time to put your name, firm name, location, and primary practice area in the chat if you would like. But we'd love to get right into the meat of things, so we will be doing that. A couple of announcements. One is that the Developing Partner section will be having a happy hour at the PBLI conference in Atlanta, hosted by Melinda Bialzik, who's on this call. So we are still scheduling which day or time that's going to be, but look out for that. That will be our networking event in the second quarter of 2025. We also have our next substantive program lined up for May 21st at 11 Eastern. That's going to be put on by Doug Brown, who did the delegation program last year that was very, very good. He's going to be speaking on the subject of the three leadership skills that make or break a partner, specifically emotional intelligence, effective listening, and avoiding leadership sabotage. So that will be really interesting. That's May 21st, 11 Eastern. Look out for that, more information on that. But today, we're going to be talking about maximizing profitability. And our speaker is Patrick Fuller, who is the chief strategist at ALM Intelligence. He has been working hard in the area of good practices in law management for a quarter century, has spoken more than 200 times on this subject and published two books as well as multiple papers. He has won a number of awards, participates in a whole bunch of think tanks and on boards of various entities. And just short answer, he's awesome. So I'm very excited to have Patrick give his presentation today, and I will not take up any more time and let him get right to it.
Well, first thing I had to figure out where the unmute button was, so I apologize. Welcome everybody. It's a pleasure to be with everyone today. Put together the deck here and kind of get into a couple of things. Ryan, did you want me to go into PowerPoint, or did you want me to just go without PowerPoint? Which is going to be best for the members?
We've done it either way. Slides tend to be helpful, and if you are willing to provide the deck to the group where you can distribute it, that would be helpful too. But it's up to you, whatever you think is
Perfect.
more effective.
Yeah, just give me 1 second to set everything up here, and I will. Let's see here. One of the problems of having three screens, guys, is you never know which screen is going to be on what. So set that up, and let me go ahead and share. Share desktop too. And all right, so everybody should be seeing the deck, if that's correct.
Yep, go ahead.
Okay, perfect. All right, good deal. All right, well, got a few things to kind of go through here, and this is probably the first thing. Whenever we talk about this subject, this is one of the questions I like to ask because I think it really sort of sets the foundation for what it is that we're trying to accomplish with some of this, and that is if we were going to start everything over from scratch today, knowing everything that we know, what would we do differently? And when I talk to firm leaders about this, it usually starts with compensation structure because of the behaviors that they're looking to incentivize. But it gets into everything from hires that they wish they had back in some cases, and into sort of decisions that they make regarding just operational components of the firm, how they go to market, how they engage with certain types of clients, the types of clients that, in retrospect, in some cases, they wish they would have said no to, because we know that exists. It's interesting sometimes in talking with firm leaders is, we'll get down to discussions around where they want to go and what they're trying to pursue. And one of the things that ends up coming out is that there's a frustration in some cases with clients that are costing them significant resources in terms of how to support them and how to yeah, and basically the profitability, but yet they're seeking very similar clients. So they're going after the same ones that are that are causing the issues right now. So this to me is one of the areas that I would start. The other thing I would tell you guys within your firm, if you're going to do some of these, if you're going to do retreats, is especially around your management committee. And when you talk to your management committee, is just start a meeting one time and say, look, if, describe in one word how you feel the current state of our firm is today. Just one word, describe it in one word, and make everybody write it down, towards visual and everybody else can see it. And then follow back up a couple of minutes later with, when we get together a year from now, what do you want that one word to be? And figure out where the gap is and how big the gap is, the gulf is between where you currently are and where everybody thinks they want to be, because that's going to help set the strategy and sort of prioritize what it is that we need to address, that we want to address, what's in our control, what's not in our control, and focus on the things that actually matter. So hopefully, as we start everything off today, that helps. The second thing that we have to continuously reiterate this, and for the record, we have to do it in corporate America too, because we are beholden in many ways to the short term in the near term. And in corporate America, it's no different than in law firms. We do a fairly poor job of calculating the current cost of future decisions. That's just reality. And where it usually comes down to is, especially in Q3, Q4, corporate America, we see this in law firms as well too. We need to cut. We need to cut, and because we have to deliver, a certain number. The reality of it is that's not sustainable. It's generally not sustainable at all, and it is hard to cut your way to sustainable growth. It just is. And we also know it's hard to spend your way to profit. A lot of us have tried, but it is very difficult to cut your way to sustainable growth. And I think that's something that we always have to keep in mind, because we have to balance the short term, as I mentioned, with sort of the long-term vision of things. And where do we invest? What do we invest in? What are the resources? What's the opportunity cost? And so as we sort of as we talk about cutting through the noise and getting into, a position in order to build sustainable growth, we first have to understand what it is that are non-negotiables and what we're not going to cut, and what we're going to invest in that we believe is going to yield growth. So that leads us into the next point I want to make really quickly, is just sort of a remembrance component in through here. We see this, by the way, at the top of the food chain, and in no way, shape, or form do I want to bring in the AmLaw, top of the AmLaw food chain, because quite frankly, the numbers are so ridiculous this year, it's not even funny. But what is interesting about that is that it's largely driven by brand equity and rate growth. And one of the things that try to get people to remember is that the clients and the people that we represent, generally speaking, are branded by advertising and marketing. That's how they're branded. We know the jingles. We have grown up with a lot of those things. Law firms are branded by results, outcomes, and experience. Right? That's the reality. There's a lot of GCs, and we have this conversation quite a bit, where we get into that situation, and we'll follow it up here in a second with the next talking point. But we get into the situation where we want to talk about rates and getting in pushback on rates and cost and everything else. And the reality of it is there are very few GCs, especially with some of the, even back half of the Fortune 500, Fortune 1000 areas, that have gotten to where gotten to where they are because they have decided to buy the lowest rate as opposed to the outcome, right? They've got to they're buying outcomes, they're buying results, they're buying experience. The economics will follow the brand. So the more that we position ourselves, even if we're a mid-sized firm, the more that we position ourselves as an indispensable resource, right? We want to be unique, memorable, and irreplaceable. Those three things: unique, memorable, and irreplaceable. The more that we position ourselves as that, the economics tend to follow, right? And there are a lot of firms that are 40 attorneys, 30 attorneys. Really good friend of mine has got 25 attorneys in his firm, that are off the beaten path, that produce numbers that, had they had more lawyers, would be blowing some of the firms in the AmLaw out of the water with regard to profitability, especially with regard to year-over-year growth in areas, especially when we adjust for inflation being able to see over a period of time that growth in revenue per lawyer or profit per lawyer. We see a lot of those firms that are simply operating below the radar because they don't have a high number of attorneys that are producing phenomenal financials because they have found a way to make themselves unique, memorable, and irreplaceable to clients. And that gets us into a pricing component. Um, I'm a big believer in this. And again, companies struggle with this, guys, on a regular basis as well, right? If there's no perception of uniqueness, differentiation, or value, price matters. And so if we're in a situation where, and I don't know if this is going to come across, if you guys can see the cursor going around, but if we're in a situation where we've got a unique practice, but there's no perceived value by the client, well, we own a non-existent market. If we get to a place where it's valuable, but there's nothing that's unique about it, it's just we're just another firm that's doing this work. We have not found a way to differentiate it and differentiate ourselves either individually or collectively as a firm, then we're going to be stuck competing on price. Where we want to get to, whether it's with the largest clients or whether it's with moderate sized clients or wherever it is we want to get to that point where we are in that area where we have uniqueness of our value proposition. And that could be anything from the service and the experience that we bring to the client experience that we're creating, the way that we engage with the client, and then the value that's derived by the firm, by the client. It's impossible for me or anybody else to sit there and go, well, this is value. At the end of the day, the client determines value. Each one of you have a different idea of what value is. And as a service provider to each of you, I can't assume that every one of you has the same definition of value. I just can't. I think that is something that is going to be determined by working with each of you. And then it's up to me to deliver what you find valuable. And so for each of you, it's the same thing with your clients. I think the one thing I will end on here is none of us want to be in this area right here. This is where we don't want to be, where we don't really have anything unique about our practice, about how we engage, and there's really nothing that's valuable from the client's perspective. And then we're stuck in this place right here, which is really sort of hard to get out of. We pulled some data, and sorry, I'm trying to figure out here why this is not moving. Did you guys ever have that situation where all of a sudden nothing works? We pulled some data. I thought was kind of interesting. This is 2024's average net billable hours. We got this from, I don't know, there's 700 responses into this. So it's a fairly decent sample size, relatively speaking, as far as surveys go. What was interesting here is to be able to sort of look at the average net billable hours. And I don't think this is going to be super surprising in a lot of cases. You see the firms, and again, we broke it up by 1 to 250, 250 to 750 and 750 plus. A lot of the 1 to 250 were actually about 80 and below in how it was broken out. But what you'll see is there's a lot more billable time going in with smaller firms. The challenge with that is that the rate structure isn't yielding the type of revenue that it should be. And in many cases, what this sort of tells us is that a lot of firms are working really, really hard and making less money. And that some of that gets into the rate increases. And we've talked about this before. Roger and I talked about this, I think, when we were in Florida last year, about a year ago. But I think I showed actually this slide for those of you that were there, and I'm getting ready to update it. We are getting all the data coming in right now. We're still collecting it. So I'll have an updated version of this probably in about 3 to 4 weeks. But what's really sort of fascinating about this is when you look at the largest firms, because they have institutionalized pricing as a function, and they've taken it out of control of the lawyers. And basically, they've given them plausible deniability in many ways. You've seen these consistent rate increases of 3% plus. When you go to the firms in the second 100 of the AmLaw data, it took a few years before it got into that same level of consistency in 22 and 23. When you look at the unranked firms, and these responses go anywhere from firms of 10 attorneys on up, you start seeing the fact that it took a long time for those firms to push their rates forward. And one of the things, and I don't have the data in this deck, and I should have brought it in, but one of the things that's been really interesting is seeing the amount of pushback that um, law firms get and lawyers get in terms of write downs and adjustments on the client side. It's disproportionately weighted towards smaller firms. And the other data point that was really fascinating from that study was that those were also, it was disproportionately weighted to smaller firms in terms of the amount of data or the amount of time that was either unrecorded or written down at the firm's behest. So the firms that have the smallest margin for error are the ones that are being disproportionately impacted the most by the economic factors, surrounding rates and time. And so this again just sort of goes to support the point that rates need to rise. And now that's easier said than done. It is so much easier said than done because you are representing a myriad of businesses, from mom and pop owned businesses to individuals to, in some cases, Fortune 100, 300, 500, large unranked private companies, et cetera. But there is a difference. And the one thing I will tell everybody is that there is a difference between premium rates and total matter cost. And one of the things that's interesting, and if I could show the data, I would, is that in one of my former lifetimes, we saw clear and convincing patterns of firms that were significantly below the average market rate for whatever practice area and, industry and things like that we were looking at the time, consistently had higher average total matter costs than firms that were above, had an average rate, build rate that was above the market average. And that was not necessarily driven by firm size in any way, shape, or form, because it was firms that were all over the board. But generally speaking, firms that had a higher billing rate at that point tended to be better at scoping, better at staffing, better at execution. And so even though they had higher rate, total matter cost was not nearly as high as the firms that had lower rate. So it speaks a little bit into the difference between higher rates and total matter cost. And this is an exercise that, and I think some of you have probably seen a version of this before, but this is an exercise that I would tell everybody to look at and to consider. And that is, and this is going off 9 years. I think I've got another one in here for 5 years as well. Maybe I don't, but it's the same sort of principle: is go back and go 5 and 10 years, or go 3 years and 5 years. Take your net collected rate average by practice area, by timekeeper, adjust it for inflation, utilize the GDP's implicit price deflator. So, for example, if I go back to 2020 right now, and by the way, when I do data, I utilize inclusive periods. So a 5-year period for me would be 2020, 2021, 22, 23, and 24. So those 5 years. When I go back to 2020, the inflation adjustment rate is 1.19. And so you're taking, that 400, for example, if we were to do this with 2020 data, multiply it by 0.19 or 1.19, and that gets what our current equivalency is as of at least a couple of weeks ago from an inflation adjustment perspective. And then you create the compound annual growth rate off of that. And when you do this, what you're going to find is that there is going to be a lot of rates that have not kept pace with inflationary growth. And that's just inflation. And so what we're not talking about is, operational growth as well, because that's not quantified at any point. And so I think it really gets into a scenario where, yes, you want to make sure that you are maintaining fiscal prudence with your clients and you're doing right by them. But at the same time, the cost to deliver services today versus what it was 3 years ago, 5 years ago, 7 years ago is rising consistently for each and every one of your firms. The cost for talent is increasing, the cost of operational components, whether it's legal research, whether it's websites, whether it's anything operational. Occupancy expense is going up in many markets as well too. So the rates have to keep pace with that level of both inflationary and operational growth. And for a lot of smaller firms, they're not. Now, on the flip side, the largest firms, they're going up at 10, 11, 12% a year. And it's not sustainable. And I think what it's doing is it's creating an opening for a lot of mid-sized firms to go in and be able to still have premium rates, still be significantly cheaper, provide better value, but also provide a significantly better client experience. Just an absolutely better client experience. And the one thing that I consistently hear from the buy side is they trade essentially the brand equity and the CYA, for lack of a better term, but the CYA component of the brand equity of the largest firms, they trade that for essentially overspending and rates and matter costs that are basically out of control at this point. So filling that void and that delta in between there, I think is an opportunity for mid-sized firms specifically. And we hear that a lot from the legal operations folks, from the business analysts and legal departments, which is we're looking for these firms. What we're looking for is for them to demonstrate their experience. We're looking for them to engage with us a little bit differently and basically help us convince the lawyers that these are the right firms to go to. At the same time, these firms should be raising their rates because they're going to be significantly cheaper, and making sure that they're covering not only their operational inflationary growth, but also setting aside revenues that can and earnings that they can retain to some degree, depending on the bylaws and the partnership structure, and reinvest into growth moving forward. So I'll pause there, Ryan. If you've got any questions, any comments, I think there's a couple of that have come in, and let's see if there's. I'm not sure if
I think
really
that's more people introducing
Oh,
themselves.
okay.
I'm
Either that or
absolutely
they're
riveted.
firing off jokes. And the only thing I would say is if you're going to heckle, just be funny. Um, you know, that would be it. But Ryan, any questions, comments?
I just want to hear more. I'm riveted by this. I'm following you perfectly. So let's see if
Okay.
there's any questions in the chat. Nope, just people introducing themselves. So I encourage you just to continue. I find this fascinating.
Okay. So one of the things that is a benefit of my job is that I get to work with firm leaders of all sizes, and get to spend a lot of time with the buy side as well. And so I put together a couple of collections in here of firms that both struggle to separate and firms that are moving. I think one of them, regardless of your firm size, is death by a thousand committees. Even in smaller firms, I've seen too many committees. By the way, this is corporate America as well too. The number of meetings that should be emails. In fact, let me rephrase that. The number of meetings that should be text messages, not even emails. Like, let's just knock it down a little bit, is out of control. Meeting culture is just out of it. Another thing, and this is a pet peeve of mine, too many firms commit to plans and not frameworks. When we talk about putting together a strategic plan, it's almost like it's being chiseled on Mount Sinai and handed down in stone tablets, and there's no change and there's no variation. And I think if anything that we've learned over the last year, just to kind of throw things in, is and make sure that we're all inclusive of time, is that there is going to be significant uncertainty and significant change. And if we're not prepared to adapt to the changing market, then we're going to be stuck in a situation where we're just not going to be able to climb out of the hole. So there's a level of agility. And one of the reasons why I always push the term framework versus plan is because I want to set the stage internally with the lawyers that there's going to be deviation within this. There is going to be things that we're going to have to adapt to, that we're going to have to adjust to moving forward, because that is what the market is dictating. So committing to a plan as opposed to a framework is, I think, gets a lot of firms just stuck in an area that they can't get out of. And then these are kind of related, these next two here, the lack of market differentiation, and then over reliance on a historical prestige. It's not uncommon for us to be able to see firms that have been passed along the way by other firms. They have held, because this is such a precedent-based profession that we're in, that we rely so much on on what the brand equity was 20 years ago, 30 years ago. And meanwhile, the firm is being passed on a regular basis. And for the record, that's the fear of everybody like me individually as well, too, that we stop learning, that we're not learning as much, we're not growing and we're not changing and adapting to the market. We fear that as well, too. But we see it with law firms. And we see it with other companies as well, where there's an over reliance on historical prestige. And as a result of that, there's a lack of market differentiation, right? And it's hard to separate. And I was talking to somebody the last week who is the potential lateral, and we were talking about a couple of the firms that this person could have gone to. And one of the questions I had for this person was, all right, you're at a firm now, and there's three or four of these other firms. Tell me what's different about them. And as a former buyer, which this person was, as a former buyer of legal services, help me understand that when you're looking at this, what are your preconceived notions? Like, you're looking at these firms, you know who these firms are, what their names are, their brand, et cetera, et cetera. Is there anything new that you're going to learn that you haven't already assumed about them in the first place? You get these preconceived notions in through there that are hard to get out of. And the reality of it was, and this person admitted it, he said, there's just no market differentiation. There really isn't. There's different colors in the logo, there's different web addresses, but the reality of it is that a lot of those firms, there's no differentiation from the perception of the buy side. And I think that is one of the issues that we see with so many firms is they're stuck into this peer group that they didn't choose. And it's hard for them to separate and get out. Big issue is lack of investment into business development and the client experience. This is a challenge. This is a challenge for consultants. This is a challenge for companies. When you are the busiest and you have the most, when demand is going through the roof and you are working 7 days a week because the work is demanding 7 days a week, you are the busiest. You also have the most credibility in the market. And the natural inclination for all of us is to say, oh my God, I'm swamped. I can't take on any more work. Yeah, we don't need to spend this money. We don't need to go do these little things that we need to do to keep the pipeline going. And the reality of it is counterintuitive as it is, even for consultants, is that's when you need to be doubling down in many ways because you have the most credibility in the market at that point. And your stock is at the highest. And so there is that natural tendency to pull back. But the other part is that too many firms are not putting enough enough investment into BD in a way that's going to differentiate the firm, right? They are late to the party. They will be the third or fourth or fifth responding to an opportunity to pitch, or they're responding to RFPs. And don't get me started on RFPs and just the massive time waste that goes along with them and huge opportunity cost. Whereas a lot of that money, a lot of that focus should be redirected into the client experience, whether it's through client teams, whether it's through how we engage with the client, the ancillary services that we're providing that differentiate our a little bit from everybody else. We're not going to charge for every little thing. Yes, we want to have premium rates, but we're not going to charge for every little thing. We're going to do things that are in the best investment in investing in the client success. We're going to do things just a little bit different because what we want to find is differentiation that we can create demand around. That's the goal. That's what we're always looking for. So firms that are not investing in BD as a strategic differentiator, they're not investing in the client experience, they get stuck in that pack and it's hard to separate from that pack. And once you're looped into that, it's really hard. This I'll hit on. I'm not sure how much of an issue it is, but I see it with a lot of firms, which is a high concentration of really low staffed offices, especially in non-strategic markets. And I say that because I live in Oklahoma, and all the jokes that anybody wants to make, fire them away, because I basically live on airplanes. But there's a couple of firms, national firms here that have offices, and it's a great example of this. They've got one or two people in the office. They don't need an office here. I mean, honestly, they don't. And talking to a couple of the firms, they're struggling in markets like this. Or pick a state, any state, market, any market. If you have a high concentration of poorly staffed offices, you are going to see significant occupancy expenses that are dragging down your profitability. And there are certain markets that, if we wanted to do an entirely separate session, we could do this, but there are certain markets where if you expand into those markets, you've got to have a clear, defined strategy and really be able to have a list of people going into that you want to go after, because it's been really hard historically for firms to grow once they've opened offices. And one in particular, I'll just call it out, is Raleigh Durham. It's one of the best, I think it's one of the best markets in terms of growth potential in the U.S. right now, because of the lower barrier to entry and the upside in the research triangle and the universities that are there, and the startup culture and the venture capital funding that had been rolling through there. But it's also a really hard market in order to attract laterals and grow the firm there. So it's one of those it's one of those situations where if you're going to go into that market, you've got to have a plan, and you've got to be able to have an executable plan if you're going to grow. A couple of other areas here: weak financial discipline. This goes back to what we started off at the start. It's really hard to cut your way to growth. It's sustainably, it's hard to spend your way to profit. So having poor financial discipline is an issue. Resistance to technological innovation, and this is the hardest part, because I think what we get into right now is it is beneficial in certain areas with certain types of technology to employ a last mover advantage and not a first mover advantage. I'm sure there's some of us on this call who bought the $800 CD player back in the day, or who was going out and buying HD DVD players until Blu-ray took it over. And those types of things, we've experienced this as consumers. I think right now we've got technology that is moving incredibly fast. There's a high cost to it. There is a high upfront cost to it. And when you start getting into anything with large language models and reinforcement learning, anything along the automation/AI perspective, you're also going to have a lot of non-billable cost that goes into it. So I do think that's one of the areas where firms that are resistant to technological innovation, they struggle to separate, but at the same time, they have to be smart in the selections that they do take, and they do have to take some form of risk. But in order to do that, they also have to make sure that they are adapting compensation structure and fee engagements to align with what it is that they're doing. And so that's usually where the challenge arises, is that they are not doing a good job. They might invest in something or license a specific technology, but they haven't adjusted anything. And I was talking to a firm leader last week, and they were licensing a AI platform. And I asked this person, I said, what's the plans? What problems are you solving? They said, well, we're going to figure that out. I was like, you've got to be kidding me. You're spending all this money. They're a 40 some odd attorney firm. They're spending all this money licensing something for everybody. They don't have a plan of what they're going to execute it. They haven't done anything with their comp structure. They don't know how they're going to sell it or how they're going to price it, but they want to put a press release out that says that they've licensed it. And there's no differentiation in that. There's no cost benefit in that whatsoever. In fact, they probably really impacted their profitability, and it's going to cause internal dissension. And so again, having that sort of discipline, I think, is going to be really important. And then two other areas here, because I think they sort of go together. One is an overdependence on aging rainmakers. I say that as somebody who's in his 50s now, and I realize that that's a self-own, as the kids would say today. But it is, everybody on this call is going to face a succession issue. They are. And I think it's more challenging with mid-sized firms than it is larger firms, in part because it's not just a succession issue, it's also a marketing issue. And when you have firms where you have the first generation still of names still on the door, still on the letterhead, and especially with so many originations that are originating from a named partner, and that person decides that they're going to retire, now you've got both a succession issue if you haven't planned accordingly for it, not only at the leadership level, but at the client level, but also from a marketing and a brand perspective as well. So how do you handle the transition? That's something I think is, and none of us ever want to talk about it either, right? I mean, it's like filling out our wills and that sort of stuff. So that's something I think is going to continue to plague firms. It's something that we need to address. And then the high turnover and poor lateral integration. I cannot stress this enough. I spoke recently. I was down in Florida at the National Association of Legal Search Consultants, where, by the way, it's intimidating to be lowest paid person in a room, um, when everybody else doesn't, they don't build anything. They don't, they basically are non-practicing entities. If we're in the patent space, we'd be talking about them as NPEs, right? They don't build anything. They just transfer knowledge from one firm to another and get paid 25% of the first year guarantee. And I'm sitting there and I'm talking to some of these folks, and they're doing 15 to 20 placements a year at a million plus, million and a half average, 25% um, commission off of that. And I was really thinking I need to go hunt down my guidance counselor, because I clearly got some bad advice somewhere along the line. But in talking to them, I asked the question and I said, okay, are there certain firms, big, small, medium, wherever it is there certain firms that you absolutely do not want to place people? And it's amazing how you can hear so many people in a salsa bar in Miami when they start getting fired up about something, because the answer to that was emphatically yes. And for a litany of reasons, but they fear the clawback more than anything else. And there are firms that, they name specifically, and I won't get into, where they just said, we will not place anybody there because they do not do a good job of integrating laterals. They are not set up for success. Yeah, they pay our fee, but we send people there and they just flail and they're gone. And one of the data points I think that's really interesting, and I'm not sure I put it in here, but I work closely with a group out of St. Louis called Decipher Investigative Intelligence, and Decipher does due diligence on laterals. And one of the things that's really interesting is their data shows about a 55% failure rate after 5 years on laterals, meaning that after 5 years, 55% of the laterals that joined are no longer with that firm anymore. Of the 45% or so that are still around, more than half have never made back the firm's investment. And so when we start talking about all the firms that don't have margin for error, this really jumps. This is really an issue that jumps up. Okay, well, that was the bad news. Now let's look at the good news. I think a couple of things, regardless of firm size, a strong brand entity. There are firms in this group right now that are on this call that I know have exceedingly strong brand entity. They don't have to be large firms. They absolutely do not have to be large firms, but what they do is they need to have strong brand equity that conveys into the client, that the client knows what they're getting in terms of the client experience, what they're getting in terms of the work product, what they can expect. They've defined that brand equity in a very, very strong way. Those firms also have the ability to consistently attract and retain top talent. Now, the other thing, and I can't speak to any of this with anybody here, goes back to what we were just talking about with succession as well. The global footprint in key strategic markets, it doesn't have to be global, but it is something that needs to be in key markets, right? If you're going to open secondary offices and third offices, is it an office in which there's going to be enough work to self-sustain that office and be able to extend your current footprint? And I think that becomes really important. And then we get into some basic management issues, right? The ability to bring people together, strong internal and external collaboration. How do we collaborate internally? How can we bring people together, operate as a unit and not a collection of individual timekeepers? How do we collaborate with our clients? How do we collaborate with opposing counsel? I think one of the things that was really interesting in my former lifetime, when we would working with corporate legal departments and analytics, is every single one of whatever e-billing system that any client was using, they all had end of matter of surveys that were built in. The only ones that were really religious about enforcing it were the insurance companies. And you guys can insert your own jokes there, but they were really, anytime a matter closed and they closed out a file, there was the survey that went out basically that was asking about, generally speaking, was asking about legal ability, case management, and then of course it would be, would you hire this lawyer or firm again? And the number of times, scale of 1 to 5, that the 4s and the 5s were around legal ability and case management, but it was a 1 for would you hire this lawyer or firm again was really interesting. And what became of that is that we started seeing questions being added into that around, because there was so much collaboration with local counsel, and also how they engage with opposing counsel, was the questions around collaboration. And a lot of firms initially were struggling with that until the expectation was set. So that ability to collaborate with opposing counsel, I think, is there. I'm a big believer in demand creation. demand generation. Whether, and I don't, everybody uses something a little bit different, whether it's Law 360, whether it's stuff from ALM, whether it's Courthouse News, whether it's Thomson, Lexis, whatever it is, your own thought leadership, the ability to make sure that you are keeping top of mind, tip of the tongue. How many times have all of us gone to lunch with somebody that we haven't seen in 3 years, and then later that day or 2 days later, something comes up and you think, who'd be perfect for that is Bob. I just had lunch with him the other day, as a matter of fact, because it's fresh in your mind. You want to do that with your clients, even if it's not something that you think is particularly valuable. You want to maintain consistent touch points, but do what you can to just seed opportunities in through there. Hey, FYI, this isn't something that you need to be concerned about right now, but file it away because it's something that we're monitoring with regard to ABC that's going on with a couple of these companies in your industry or in your sector, right? Or, hey, this is going on in these two adjacent sectors. We think that there's potential for this to sort of creep into this area. We want to keep you informed on it so you can manage expectations internally, yada, 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 yada. I think that is really important in terms of issue spotting and horizon scanning. I can tell you, and I've got a slide in through here that speaks to this, that when we talk to legal departments, the number one thing that they're looking for is on a regular basis is know our business, know our industry, and keep us informed on a proactive basis. And then a couple of areas that go along with this, I'll just hit on really quickly as well too. Investing in the success of the firm's professionals and the client success. I sort of hit on it already with the client success, but from a profitability perspective, I don't want to be turning people over, whether it's business professionals and staff members or whether it's attorneys. I want to make sure that I'm investing everything that I can in the success of the people that we brought in with us. And we all have this tendency to sort of look across the fence, and the grass is always greener. It's a different shade of green, et cetera. But the reality of it is that, the more that we can invest in our clients' success, in our internal success, in our team member success, the more profitable in most cases we're going to end up being. And the reason I say that is that replacement cost is always going to be higher than incumbent cost, generally speaking, anyway. There's probably a few times when it's not, but for the most part, it's always going to be more than incumbent costs. So what are we doing, and how can we then tell that story as part of the client, right? Because part of what we're looking for from a client's perspective and a buy-side perspective is consistency and predictability, and it's not just in the bills, right? I want to know, and I want to share this as part of the kickoff meeting and the pitch and the client engagement. I want you to know that we've got a succession strategy. Part of that strategy is that we're investing in the people that we're bringing on. We're developing them. Yes, you, the client, are going to have a say in who becomes your relationship partner moving forward. We're going to bring you into that process, but also understand that we're investing in people in a way that is going to yield long-term sustainable relationships and development within our firm. We don't have, and just be upfront with them, we don't have the ability like the bigger firms do to cycle through people on a regular basis. We don't have that margin for error, so we've got to get it right. But what that means by getting it right is that we're going to serve you better than they ever will in the process. And that's creating those switching costs. The other part, and this comes up, and I'm going to give credit to a friend of mine at Ford Motor Company who brought this up to me, who's an analyst. And he asked me one day, we're kind of going through, the basic consultant speak, blah, blah, blah questions. And he said, he goes, one of the things, and he's got a deep Southern accent too. And he goes, one of the things that we've always sort of looked at was, are these firms matching the speed at which we want to move as a company? Because if we can get a deal done 3 weeks faster than our competitors and something like that benefits us, and it gets the board off of our back and everything else. And I thought that was a really unique insight, right? Which is to ask ourselves those questions, regardless of whether or not we're dealing with a mom and pop or we're dealing with, a multinational corporation. Are we moving at the same speed that the client expects us to move? Are we moving at the same speed of their business? And then I'm going to end on this one right here for this, but I am a huge believer in creating intangible switching costs. So whether we're doing it internally with staff, right? I don't want to lose somebody for 10 grand or 20 grand a year more to a competitor. I should not be losing people for that. Not that I'm going to just pay people, but I want to create an environment where the money is not as important. All things being equal or somewhat equal, we're creating an environment where people are going to grow, they're valued, they understand that they're valued. We have high expectations, but we are going to invest in their success meeting those expectations. The same thing goes with clients, right? We're not going to be the most expensive. We're not going to be able to solve every single need, and we're not going to be the firm in most cases that's going to put fear in the minds of opposing counsel or always, have the board go, absolutely, that's incredibly the right move. But we're going to make you look like a rock star, and we're going to do everything in our power to make sure that everything that we do is going to be done to make sure that you are, in a position for success. Like, we want to know how you're being, what drivers are being utilized in terms of metrics and analytics that are going to drive your compensation so we can manage to those. We want to make sure that you're hitting your bonus. We want to make sure that we're forwarding information over to you and horizon scanning and keeping you abreast of things that could be going on so you're not blindsided by anything. And oh, by the way, little things too. This matter that sort of went off the rails and this issue that popped up in through there. Yeah, there's a 40,000, this next invoice is going to be $40,000 higher. We're going to let you know what it is and what drove it and what happened before you get the invoice, right? We don't want you getting those surprises. We're going to attack this stuff head on so you're not surprised by anything. Creating those switching costs, they're intangible switching costs. You're not going to be undersold by those. Those are the types of things that drive loyalty. And to me, it's a big difference between loyalty versus satisfaction. And that's what we want to get to as an organization. I mentioned, the whole deal with switching with succession. We're starting to hear it now over the last 18 months. I've heard it repeatedly from GCs. Whether we do it in roundtables, this was done at the Wicker Park Leadership Roundtable in Chicago last year. This is where these quotes came from. But we've done it with roundtables that we've hosted. We've done it at other events, and it is coming up on a consistent basis. And there's two things that sort of come to mind. One is that firms are not informing us what the succession plan is, and it's less to do with the firm management, more to do with the relationship with the client. The second part, and this was brought up in one of the quotes here, is firms are just saying, well, here's your new contact. At some point, the client sort of chooses. I hope we're not getting to the point where we're bringing in arranged marriages back, right? Because that's kind of what it is. Like, we want to provide a number of people for you to be able to get to know. But here's the thing, that to me is one of the easiest ways of facilitating, growth and client and cross-selling, right? Is, hey, you know what? We want to make sure that you're part of our succession plan. Part of this is I want you to meet some of my other partners. We realize that you're likely not going to use, you may not be utilizing them or what they do, but they might be the best person as we sort of transition to leadership and your relationship with us. They might be the best person to be your point of contact. And you might hit it off with somebody. And I love this approach because what it does is it allows us to take a client team approach and bring in succession into it in a way that's a little bit of a Trojan horse, but the intent is pure in terms of we want to make sure that we're giving you the ability to meet different people within our firm. You're getting to meet what makes our firm so special, what makes it unique, what makes us different from everybody else. You're getting to see the collegiality. And yeah, you might connect with person A or person B or person C, even though you may not be utilizing them for work. They end up being your relationship person moving forward. And so it's an interesting way of accomplishing a couple of different things, but bringing them into the process. And this gets into client feedback interviews. And we do a lot of work. I mentioned Wicker Park Group a second ago. Wicker Park is a consultancy that we do a lot of work with that basically what they've always done is client feedback interviews. And I put a build into here and hopefully that popped up. Perfect. One of the things that jumps out is that smaller firms generally don't do client feedback. And I can't think of anything that is more within our control that we can control that we're not doing than talking to our clients about what we're doing right and what we could be doing better, because we're going to uncover opportunities through this as well. And a friend of mine who's at a firm in Boston, she's written a book on this. And one of the things that she talks about in this book is it doesn't have to be a big top-down rollout. Like, let's not make it a big thing where we've got committees and everything else. Go talk to your client. It doesn't have to be formal. It doesn't have to be structured. But part of what you want to be able to know is, hey, what are we doing? What are we doing well? What could we be doing better? What is it that you're anticipating or issues that you're dealing with that maybe, you want us to be mindful of moving forward so we can serve you more effectively and better? Like, have those conversations with your client, whether it's a mom and pop, whether it's a small family, small family-owned business, it's a smaller private corporation, whatever it is. Have those conversations. And what's interesting is that I talk to even some of the largest companies, and we'll talk about client feedback. I I rarely run into lawyers who say, oh yeah, we get these on a regular basis. So we know that they're being done. I question who they're always talking to as well. So again, it gives you an opportunity, I think, to, go to the person who is your primary contact, get that feedback. You don't need to farm it out to consultants. Don't get me wrong, we like the money. We're capitalists after all, but it's something that you could just do by yourself. And then the one thing I would tell you to do is catalog everything internally, record it, start thinking about what your net promoter score is going to be. How likely are these people to promote you and recommend you to somebody else? Start calculating some of that so you've got a baseline, because if you want to be able to improve it, you've got to be able to measure it. But I mentioned some of this earlier as well. When you start thinking about the information that the buy side tells us on a regular basis, tells Wicker Park that they're looking for, it's being proactive, it's doing the horizon scanning and doing that type of forward-looking, peeking around corners, issue spotting component, sharing that insight with analysis. It doesn't have to be long, but it's got to be something that essentially you want to spur a phone call. And then when they start looking at hiring criteria, it is expertise, it is knowledge of the company and industry, it is experience, how you've solved the big problems before. And rates and efficiency play a role into that, but not as much as I think people think. And at the same time, I think that if we were to put a truth serum into some of the GCs, they might answer this a little bit differently as well too from time to time. So I think there's a little bit of a delta both ways there. But the reality of it is your experience, how you solved big problems previously, how you've been able to demonstrate that, how you can talk about sort of the big picture client experience, how you convey your knowledge of the business and the industry is going to go far further in terms of generating opportunities. All right, I know we're coming up on time, and so I'll hit on a couple of things here really quickly. Just these are consultant speak 101 questions, guys. Sorry. And at some point, I'm going to ask each of you if I can borrow your watch, and I'm going to charge you for telling you the time as well. But this is, to me, this is one of the most impactful questions that we can ever ask, which is, are we getting the greatest impact from the most members of the firm? And that whether that's staff, whether that's attorneys, it's the single biggest expense that we're going to have as an organization. Maybe it's going to be occupancy if you've got a high concentration of offices, but it's one of the, if not the, it's going to be the second most expensive proposition in your balance sheet. And are we getting the best impact from everybody? And if we're not, what can we do to improve that? So is it how we engage? Is it how we invest in their success? But what is it that we're doing or not doing that to achieve the biggest impact from everybody in the firm? This to me, I think is a critical component. The other one here, and I love this question, do we have new ideas and where to look for new opportunities? I don't want to keep going back to the same route. So I've mentioned this before, but I'll tell this to all the litigators that are out there. You don't have to answer now, but I can almost guarantee you that for everybody that's on this call, when you get a copy of a complaint, you will smile and chuckle from time to time when you see opposing counsel, because you've just kicked their ass, right? Let's just be candid about it, right? You just absolutely waxed them all, just walked the floor with them. Sorry, using sports terms and Southern terms at the same time. But you just sort of wax the floor with them. So the question I have is, if you're paying Westlaw, you're paying Lexis, you're paying any of these other services, Courthouse News, why are you not setting up alerts on the individual's name and the firm name? Because everybody has that standard letter that's somewhere in the file, which is, oh, sorry to be the bearer of bad news, but you've been named in this new complaint. The good news is that we have significant experience efficiently and effectively mitigating risk, and we'd love to sit down and talk to you about why we've been so much more successful against insert name than everybody else has. And let your experience sell for you. But it's a way of finding, again, you don't have to have these great plans for where to look for new opportunities, but what you do need to do is figure out ways of attacking new opportunities differently. And so this is one of those areas. Too often when I've worked with firms from a BD perspective and a strategy and a growth perspective, we start working through this list of, well, these are the firms, these are the companies that we want to go after. And I've got relationships over at this company, and it's a finite universe. Start utilizing your experience, start utilizing your success to sell for you and open up that universe, right? Let the people whose butts you've kicked on a regular basis introduce you to new opportunities. Find new ways and where to look for new opportunities. And I brought this up. In fact, I used a version of this slide right here at Legal Week last week, and it was really interesting. As soon as I mentioned Frank Zappa, there was like 5,000 people in the audience, and I could swear that half of them were trying to Google who the world Frank Zappa was. Which, if I brought up the mothers of invention, I'd even be in more trouble. But this is Frank Zappa is one of the smartest musicians that's ever sort of walk the face of the earth. And this quote to me is incredibly important, right? And we utilize it a lot internally in my organization. We did it with our team because, the intelligence business, we had to do something different. We couldn't do the same as what everybody else was doing. So, if we don't deviate from the norm, progress is impossible. The challenge is that we are, essentially working in, like I mentioned, a precedent-based industry, which is problematic. All right, next question. Are we seeing opportunities our competitors do not? And there's a follow-up to this, which is if we are we beating them to it? We don't want to be the third or fourth to the party, right? I'll tell you right now, I hate RFPs. I mentioned it to you earlier. I think, there's a company that's called Pursuit, that's out of Australia. They're really good people. They are really good people. They have offices over in Tribeca in New York. I enjoy working with them, but they are making everybody's lives a living hell because they have basically taken the RFP and the reverse auction and made it an all-you-can-eat platform and sold it to procurement departments. And, it's going to cost us 100 hours, 150 hours, 200 hours, depending on the complexity, to reply to something that's going to give us 11 to 12% chance of winning. And by winning, we mean the standard language that is, acceptance into the preferred provider program is not any guarantee of future work. Right. So we've got to figure out ways of looking at opportunities that our competitors are not seeing. But even if we're seeing the same thing, how do we beat them to it? This is where speed comes in. This is where agility comes in. I want them answering to my strengths. I don't want to answer to their strengths. I don't want to get in that situation where we are now having to discount or feel like we have to discount because I don't have the margin built into my rate. Right. So I don't want to get into that game whatsoever. So are we seeing things that our competitors are not? Do we know why our clients buy? I ask this question on a regular basis, and you'd be surprised the number of times I don't get the answer. And just ask the question especially to your clients in corporations that are utilizing e-billing systems. Walk me through the process of approving invoices. Most of your lawyers in the firm can't do it, and you'd be surprised how many answers you're going to get when you talk to your clients about that. That there's a plugin for Outlook that ABC company has built. And as long as it clears the red flags that have been set up to auto reject certain components of it, they just click approve because they're so focused and so busy on everything else. Meanwhile, we're obsessing over pre-bills. We're writing stuff down. We're self-commoditizing, and they would just go ahead and pay it. So understand why your clients buy first and foremost. You don't have to know how to sell. Understand why they buy. Understand what they're buying. Right. And they're not buying the lowest rate. They're buying results. They're buying outcomes. Right. If there's no perception of differentiation or value, then they're buying rates. Right. But they're buying a solution to their problem, whatever that is. And then how do we shorten that process? How do we get from point A to point C is faster than our competitors are getting there? And but by the way, guys, this gets in a little bit of Moneyball components as well. Think of it this way. People buy with emotion, they justify with logic, right? So we want that emotional connection. We want people to come in and be able to say, I really want to work with ABC. You guys are great. You're also a smaller firm. You guys get that. Help me justify it, right? And this is where the logic comes in. This is where the experience comes in. This is where all those elements will come in. I don't want to be the lowest rates in this point, right? I want to be able to let my experience and my success justify why it is that we're going to have premium rates. We're likely going to be cheaper than any one of those AmLaw 25, 50, 75 firms that they might be looking at. But that doesn't mean that we need to have lower rates through the process and have lower margins in through there. The other thing I'll tell you guys really quickly as well, too, just a little, and I mentioned this when we were in Miami, and I think I told Roger before I said it too, that this was going to be the corniest thing that everybody was going to hear. And coming from me, that says a lot for the record. But I'm a huge believer in the fact that relationship partners at the end of every year, whether or not you're building rate increases into your engagement letters or not, or you're sending out notices of rate increases, because I always love that order we rolled things out in, which is, hey, here's our holiday card, which is no longer a card. It's a link that nobody clicks on because we've all been conditioned that we shouldn't click on links that we don't know where they're going because of phishing attempts, right? So nobody clicks on that link that we just spent a bunch of money creating. And then, 3 weeks later, we roll out the letter of rate increase to them. It's kind of a weird order how those things go. Write a letter, thank the client, have your partners do this. Thank your client for the first and foremost for the opportunity to serve them. Lead with that. The second thing is thank them for their collaboration and partnership throughout the course of the year. The third thing is recap everything that you've accomplished throughout the course of the year. Now, from a leadership perspective, for everybody that's on this call, this is in behavioral economics, we refer to this as a nudge in many ways, because what we're really looking for here is this is going to the client and we can set it up and that's great. I need to convince the partners that they're worthy of this rate increase. I need them to buy into it, right? So I'm sort of giving them a choice in through here, but presenting it and pushing them in a way that they're not going to have a choice but to go, you know what? Yeah, we should go 6-7%. We should go 8%. Second thing is, I know I'm getting close to time. The second thing is through there is we're collecting that experience. Now we're listing out the things that we accomplished. I want to catalog that. I want to be able to warehouse that somewhere, even if it's in an Excel spreadsheet. I want to be able to have that so we can utilize that down the road. So a couple of things, just easy takeaway, easy wins. And then here, I'll finish a couple of these really quickly, Ryan, because I know we're running out of time. My favorite question to bore the living hell out of my colleagues with, because I ask this on a regular basis, are we learning as fast as our clients' world is changing? I took this from a guy that started Fast Company magazine, modified it a little bit for legal, but the sentiment is right there. And if we are, right, if we are learning that fast, how do we demonstrate it to them in a way that they can understand it? Because if we can't, then they're never going to know, right? It's, if a tree falls in the woods, does it make a sound type of thing, right? So if we are learning as fast as their world is changing, how are we demonstrating it to them? How are we conveying that to them in a way that they know and they can absorb and take action from? That to me is a very critical element of what we're trying to do. I sort of hit on this before, so I won't spend a lot of time. Are we moving at the same pace as our client's business? If we're not, that's a problem. The other thing that we should always check is to make sure that all the letters in a word have the same color, because if they're not, that's a problem when you're looking at PowerPoints and you notice it on the fly. And then a couple of things. One, I've hit on this before. This is absolutely the truth. It's not the big that eat the small anymore. It's the fast that eat the slow. And that can't be said enough, quite frankly. So, and I'll end on this. Well, there's one more slide I'll end on, but I can't say this enough. The days of the biggest firms just dominating because they are 800-pound hammers. It may not seem like it today, but those days are dissipating faster than I think people realize. It is going to be the fast that eat the slow, not the big that eat the small. And I think mid-sized firms, we are coming into a situation right now where the market is ripe for disruption. And it's not going to come from outside of legal, because legal is too self-regulated, it's too incestuous. It's going to come from within, and it's going to come from mid-sized firms. And I am 100% convinced on that. I sort of hit on this as we touched through this, which is, our rates rising faster than the switching costs. But I'm going to end on this. And this is it, right? The last best experience we have anywhere becomes a minimum expectation that we want everywhere. We're all consumers. This is exactly what it is that we experience on a regular basis. Whatever we're doing, we need to do the same thing for our clients, right? We need to be the differentiator, because we're never going to be the biggest firm. We're never going to be the most powerful brand in that respect. We're never going to be a lot of the things that all the other competitors and big firms are. But what we can do is be the client experience that sets the bar for everybody else. We want this, guys. I'll end on this because I know I'm over time. We want this to be emotional and visceral, right? We want people pissed off that you're conflicted out, right? We want them feeling it in their bones in a way that is similar to those weird dreams that we all have, that we wake up, 3 a.m. and realize that we forgot to study for a test, or that we're facing a final. We forgot to go to class all semester. Or maybe I'm the only one that has those, in which case my therapist will be getting a call later today. But we want it to be emotional. So when we talk about emotion versus logic, when we talk about sort of bringing that client experience in, we want this to be something that's intangible that people can't take away from us, right? So I want that level, I want that visceral reaction to this when we're not involved, right? Because once we have this from a pure business perspective, now we've got the leverage, right? Now we've got the ability to raise those rates a little bit higher and not, you know, mark down our bills on a regular basis and be fearful of any of that, right? The better that we invest in the client experience, the long term, it's going to pay off for us better. That's it's just that's something that is just it's I don't want to say it's hard to argue because I've seen too many situations where it's right, but it is something that we should all be aspiring to as well. So again, unique, memorable, irreplaceable. That's what we're going for. Those three things. We don't want to be the same as everybody else. We want to be memorable. None of us want to be forgotten in any way, shape, or form or easily dismissed. And we want to make it that we're to the point that we're irreplaceable. If we do those three things, we are going to command premium fees. We are going to have the ability to say no to clients that we don't want, which is success. And we're going to be able to keep talent and develop talent around us and build sustainable practices. Anyway, Ryan, I'm going to end on that because I know we're at time.
Thank you very much, Patrick. You managed to both inspire and scare me at the same time. So that's a nice combination. And then thanks to everyone who attended. Patrick, if you are amenable to distributing your slides, it's totally up to you. But if so, reach out to Bree and she'll send it to the attendees. A reminder that we're going to be having a DPS happy hour at the PBLI in Atlanta, May 1 to 3. And on May 21st, our next substantive program at 11 Eastern from Doug Brown on the 3 leadership skills that make or break a partner. Thanks, everybody, for attending, and we'll see you at the next event.
Thank you, everybody. Have a great day.
Bye, guys.